Morning, Market Chameleons. Thanks for joining another pre-market show Wednesday morning. D, how you doing?
Good morning, Will. How are you?
Great, great. We got a lot of things going on in the chit chat, D. We can get to that, but let's do the disclaimer first. What do you think?
Sure. So, good morning, everybody. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. They should be able to help answer your questions, provide you with guidance. That's what they're there for. With that, there's a disclaimer. And
Awesome.
we could get started. So you mentioned something going on.
Well, we have people are asking about Oxy was one that had earnings the other day. I'm trying to get what he actually wants because I realized earnings happened yesterday morning was the effect on the straddle.
Okay.
But anyways, he wants to look at a credit spread. We had a question from yesterday morning. Raj was asking, who's a big contributor on the forum. He was asking about one of the, and now it's slipped my mind, not the standard deviation. It will come to me, but they're all on this morning. I'll get that to you.
The Sharpe. Yeah, I remember.
Sharpe ratio. Yeah, Sharpe ratio.
Okay. All right. So then I'll talk about both of those, the Oxy, because I think that's in the energy sector, and right now we are seeing a rotation in there. We'll take a look at that. A sector that's gotten really beat up in the last year. All of a sudden, with a potential vaccine coming out, we're seeing big rotation back into that energy sector, a big volume. I'll take a look at that, and then we'll talk a little bit about that Sharpe ratio.
Awesome.
Let's get started just to take a look at what's going on in the pre-market hours. So this is the pre-market report, and these are stocks that are trading prior to the market open. We have the most active stocks, biggest percentage gainers, biggest percentage decliners here. I'm going to filter out really quickly higher market cap stocks to see what's going on in those stocks. So I'm using this filter. We're looking at stocks, market caps, $20 billion in market cap or higher. I don't see anything really big right now popping out. One thing is I see there's 58 on a percentage that made our percentage gainers list, 10 on the decliners list. So at least market breadth wise, it looks like more positive opening when we compare, number of percentage gainers versus number of percentage decliners. I do see here one we were talking about before, HSBC, that started to climb back. That got beat up a lot. Also, during this period, we see now it's closed 24.46, trading 25.39 in a pre-market hours, up 3.8% on 81,000 shares. So not a huge amount for HSBC, but still looks like a positive open. And we are seeing two rotations back into kind of energy and the financials. And I'll take a look at that further. Nothing here, some small percentage gainers here, a couple small percentage decliners, nothing really popping out at me right now. Unless you have any questions there, Will.
Nope, we can move on.
All right, let me take a look at the unfiltered list. Here we have one up here popping a lot, up 300%, FPRX. Let me just take a look at that. Here, that's on 6.9 million shares. That's in a biotech field. So here we see, there it is, 52-week range, $1.75, $7.34. Closed at $5.34, trading $21.90 in the pre-market hours. So, blew right through that 52-week high, up 310%. Here's where it's trading in the pre-market. The range is $19.51 to as high as $26.90. VWAP, $22.78. So we're a little bit below that. Trading 7 million shares compared in the pre-market compared to a total float of 29.3 million. So very active in the pre-market hours. Here's what that chart looks like in the pre-market hours, zoomed way up, coming back in a little bit. Here, looks like there is some news out there. It's a biotech stock. I'm not going to get into the news, but you could see it up here, some of these headlines. They're showing some positive, data on I guess, cancer studies. But let me just take a look really quickly. I don't think it's had this kind of a pop. That's very unusual, but let's just take a look. This is its gap history. So in the last 3 years, these are the 12 largest gap moves to the upside. These are the dates. Here's the percentage gap moves. So we see on average, the 12 largest gaps on average 7.7%. Nothing like this 310%. That's like way above. Obviously, there was a big catalyst behind this move. I'll let you guys read about it. You make the decision. I don't know much about this stock, but that one's definitely popping up on the radar, up 300%. Since we had a few questions, maybe I'll move on, Will, unless you had anything.
No, move ahead.
All right. You mentioned OXY. I wanted to look. I'm going to take a look here on my watch list and show you guys. These are my watch lists, and these are the sector ETFs. I'm going to take a look at the price performance here. So we see in the last 2 weeks, SPY is up 4.7%. And here are some of the rotations. I'm going to take a look. So the biggest percentage gainers here in the last 2 weeks, energy and financials, which we see here. Look, on a 1 year basis, energy is still down 37% on a 1 year basis. From year to date, which is almost 1 year, down 40%. Financial sector, that was also very weak, still down 7% on a 1 year basis. Year to date, down 10%. But we see these last 2 weeks, a lot of money flown back in. I think now that if we're going to start getting out of if this vaccine if it's going to work and people are going to start coming back, going out again, a lot of these industries will start opening back up, with travel, cruise, more transportation. These might stand to benefit that, I think, is the bet. And like here we see, the Reits also are coming back a little bit. They've been weak. And in the last 2 weeks, here's where these were the actually lag. They're still up, technology, consumer discretionary. They're still up, but they've been the laggards, right? So a little bit of money maybe flown out of there, going into the other sectors, because you could see on a 1 year basis, they've had some pretty big gains, 38.9% technology, 26.2% in the consumer discretionary. And just to give you a peek let's just take a look at this one, XLE on the energy sector. I'm just going to see what kind of volume. I'm going to go here to the historical data. And this really popped on this right here, November 9th, when they announced that Pfizer announced that they have that vaccine, 90% effective. And look at this, it was up 14% on 99 million shares in this XLE ETF. And we see that's way above, right, what it typically trades, about 3 times higher. So in a lot of volume, and then the following day, again, a lot of volume up on that day. Could be short, a combination of short covering on this event and people rotating back in. But one of the things is when something reverses, right, reverses direction, you will see that, it'll usually begin with short covering, right? So that's XLE. You mentioned OXY. That's probably in here. I'm going to take a look at XLE. Let's look at the holdings. So here are the holdings in XLE. Here's OXY right here. I think they already reported earnings.
Yeah, it looks like after the market close on the 9th.
Yeah. So we see here on a 2 week basis, It's up 39.4%. So let me just, I'm going to sort this by. So look, in the XLE Holdings on a 2-week performance, DVN up 45%, OXY, that one's second in line, 39.4%. So that's really quickly just going over the energy sector. OXY, I think you mentioned earnings, but I think they already reported earnings, I'm pretty sure.
Yeah, well, he was I don't know if he's looking at something coming out of earnings. He asked about doing a credit put spread.
Yeah, so November 9th, they reported earnings. Let me see if we had anything filtered out on a credit put spread. So right now I'm on the summary page, OXY, and let's see if we detected any opportunities in credit put spreads. So here's a bull put spread credit. So here we go. There are 3 of them that we detected as opportunities. So this is the first one. In December 11th expiration, selling the 13 put, buying the 10 put. So $3 put spread for $1.08. We think it's worth 74 cents. That's 17.9% theoretical edge with a historical probability of success, 73%. Here's another one. This is December 4th, selling the 11 put, buying the 9 put. So that's a $2 put spread. The credit is 30 cents. We think it's worth 4 cents. That's 15.3% theoretical edge with a historical probability of success, 94%. This third one here, December 11th expiration, selling the 12 put, buying the 11 put, so $1 put spread. Credit right now, 30 cents. We think it's worth 19 cents. So that's a 15.1% theoretical edge with a historical probability of success, 73%. So those are the 3 that we detected from our preset filters using the credit put spread screener. So there you go. Stock's still, $12.53. So it's not a high priced stock. But those are the three credit put spreads that we detected. Is that helpful?
Yeah.
Okay. What was the next question? I'll get to that as well.
Sharp ratio.
Okay. Was there a specific screener he was looking at, the sharp ratio?
He didn't say. Let me.
Okay. Let me see if I could find it over here. Maybe it's in the seasonality. All right. I'll take a look at it. I'll use this one as I'm going to use the seasonality screener as the example. Okay. Seasonality. Let's take a look at the calendar month, November. I'm going to set this 8 years of observations. Let's take a look at something in November that tends to rise. So over 70% of the time, it's had positive returns. Let's set that to average return of 1% and median return. Let's say, why is this 1%? You know what, let me do also higher market cap. Let's do a market cap 20 billion. So right here, so this is the question. What is this sharp ratio? Okay, that's what the question was. How do you use it? Was that the question, Will?
Yeah.
Yeah. Okay. Before I explain this, before I show you the numbers here, let me explain what this is attempting to do. Why we use the sharp ratio is that right now, when you're investing in stocks and options, we're talking about risk assets, right? These are not riskless assets. These are risk assets, meaning the outcome, if they're going to go up or down, is uncertain. That means you can lose money, right? And how do we determine, if you should be investing in a risk asset or not? And models say, well, if you get a riskless, so there is a risk-free rate, right? The risk-free rate is the treasuries, right? Because the government guarantees that. So there's no volatility in a treasury. You know exactly, if you buy it at maturity, you know exactly what you're going to get. So let's say 1%, right? So if you're going to get 1% in a treasury and it's risk-free, if you're going to take that out and invest in a risk asset, you should be, and you have potential to lose, you'd have to be making above that risk-free rate. Otherwise, you're better off at the risk-free rate, right? And I guess maybe you could consider like a CD or money market that's insured by the FDIC, kind of like the risk-free rate as well, all right? Usually we reference the treasuries. Right now, obviously the interest rates are zero, but if you're investing in a risk asset, you're trying to make above that rate, maybe a significant amount above that rate, or else you're just better off holding your money at the risk-free rate. So that's the number one thing. So now you're always trying to maximize your returns once you go into the risk, because you're going into the risky assets. You're trying to maximize your return and minimize your risk. That's your goal, right? You want higher returns, but you always want to minimize your risks, right? So that way, so to do that, we use ratios. Of course, we don't know exactly what the return will be or what the risk is. So these are all estimated. What you expect to make versus what you're expected to risk. Okay, that's the ratio. That's what the Sharpe ratio is there for, to help traders in their models make better decisions. And of course, these are all estimates. You don't know exactly. If we knew exactly, it'd be risk free. So you create these models. What do I expect to make versus what am I assuming my risk is? Now, I'm going to use this just here as an example, and we're just using, for this model, we're using historical returns, and we're using historical risk to create these ratios. Now, again, this one right now, it's assuming that interest rates are zero, which they are. So it's not reducing your expected returns by a risk-free rate, because we're just assuming that's zero right now. So here's like one in A. Let me see. I don't know what this is. So this is Agilent Technologies. And we see here Agilent Technologies, historically in the month of November, it's been, if you bought it right at the end of October and held it to the end of November, right? So last day of October, last day of November, historically, the stock has increased, all 10 years. Out of the last 10 years, it's increased every time. The average return is 5.4%. So that's the average return. The median return is 6%. So why are we comparing it? Well, the average gets skewed, right? Because if you have one really big year, that could skew the entire average up. So then we start comparing it to the median return, which is like right in the middle. This way we could see if the average is skewed one way or the other too much. And these seem, kind of close. The median return is actually a little bit higher. So that's one of the ways that we're looking at it. We also look at the range of returns. So the range is 11.7 and the worst return is 0.6 because it's been up each time. And the range could help us also now gauge. So here we're trying to gauge the potential return, right? What do we think we might be able to capture if these are the averages? And then we want to look at the risk. So there are two few different metrics we could use for risk. One is like the range of returns, because if this range is very wide, there's more risk, right? Like if this was best return 150%, worst return, 90%, the wider the range, the more the risk, right? The narrower the range, the less perceived risk, because that's volatility.
Hey, D, real quickly, could you just show the chameleons how you got to this page again? I don't know. Ahmed may have, I know he's on earlier. Maybe you missed
stocks, and I'm on a seasonality screener right here. Okay.
Awesome.
So they're the stock menu seasonality. And I'm just using this as one example of, because we're trying to see what this means. right? When we're building our models, because your models are kind of help you drive your decision making. So here are some of these metrics in front of us, right? We see how much potentially this could go up in the average returns it's had historically. Now remember, I'm only using historicals. I'm not using any kind of forecasts, because if anything's going on in Agilent right now, if something's different in there, you have to take that into account. We're just looking at it, trying to paint a picture using the historical data in the absence of not knowing anything else about what's going on right now. So here, now I'm getting kind of like an idea of the range of moves. The other thing we want to take a look at, and this is a comment, now this is another common way. If we're expected, let's just say we use this as the expected return on average, 5.4%. So the idea is, well, if I did this trade over and over and over again in the long term, maybe it'll be close to 5.4%. Well, then how much risk are we taking, right? We want to know how much return am I getting per unit of risk, right? Because this isn't a riskless asset. Anything could happen. There could be positive news or negative news coming out. It's all random. We have no idea. But how much perceived risk am I taking? So another way, so there's a couple ways we could look at it. And this Sharpe ratio is taking the standard deviations of the returns, right? So what is the standard deviation around this average, right? So if the returns are very high around the average, the standard deviation will be higher. If the returns are very close, if they're all 5%, 6%, 5%, 6%, the standard deviation will be lower. If the returns are negative 3%, positive 12%, negative, then the standard deviation will be higher, right? So the higher the standard deviation, the more risk you have. Remember, why do we diversify when you invest in the market? Why do you diversify? Because you're trying to lower your standard deviation, right? You're diversifying to lower your risk. That's decreasing your standard deviation of return. So over here, we see this is a standard deviation of 4. So to kind of compare, all these different stocks, we could take and say, well, if I take my average return 5.4 divided by my standard deviation, then I get this Sharpe ratio. Here it's 1.3. In other words, that you want the higher this ratio, the better, because you want higher expected return for lower expected risk, right? We use it as standard deviation. Some people, now there are different ways to create these ratios as well. Like some people will take, well, what is my expected return by my max drawdown? So let's say here, what was the worst return in the last 10 years? You could do that as well. Usually what you see is the, your expected return, what you projected versus what you're projecting your standard deviation. That's the Sharpe. Is that helpful?
That's helpful, buddy. That's helpful.
All right. So that's the Sharpe. If there's no questions, I'll move on.
Sounds good.
Okay. Let's go to the earnings. Let's see what's upcoming in the earnings front. So earnings. So right now I'm looking at stocks that are expected to report earnings in the next 2 weeks. Let's go to this tab. I'm going to filter by stocks that trade on average 5,000 option contracts or more per day. And let's just see what's coming up here. So this one, Cisco, that's expected to report tomorrow after market close. As of yesterday's close, this straddle was implying a move of 6% in either direction. So that compares to a 4-quarter historical average move of 7.1% and a 12-quarter average move of 5.6%. So we see right now the options are implying it's 1% below the 4-quarter average, almost in line with that 12-quarter average. High move on Cisco in the last 12 quarters, 11.2%. AMAT, I'm just trying to go to the more popular symbols here. AMAT, that's also expected tomorrow after market close. Expected move right now in AMAT, 5.3% in either direction. That compares to a 4-quarter average move of 5.1% and a 12-quarter average move of 4.3%. So that's almost in line with the 4-quarter average, 0.2% above it, 1.1% above the 4-quarter average move, and the high move in the last 12 quarters, 9%. Disney right now expecting the straddle is implying a move of 4.7% in either direction. That compares with a 4-quarter average move of 3.8% and a 12-quarter average move of 2.6%. And the high move on that in the last 12 quarters, 8.8%. Let me see this DKNG. I think we've been talking about that, but this one's relatively new. We don't have
DraftKings, yeah.
DraftKings. Some of these are coming out a little bit further out, so I'll leave these. These are November 16th. One more thing, maybe what I wanted to talk about is if we have time. I think we have a few more minutes, but do you have any last questions?
Well, the Oxy, I was wrong. I said a credit put spread. He was looking at a credit call spread that he pulled off our earnings opportunity screener. I wondered if you could just walk through it. He's looking to sell the 50 delta call by the 25. So it's a bearish in OXY credit call spread.
Okay.
It's he's looking at doing it one day after earnings, which now it's 2 days, obviously, and then taking it off in a week.
Right. So keep in mind, right, that whatever you're doing historical data, your outlook has to be bearish, right? So if you're doing it, your outlook on Occidental, if you're doing a credit call spread, your outlook on it is bearish. Credit put spread, your outlook is bullish, right?
So yeah, well, that's what popped into my head because we've talked about this rotation the last couple of days, and all these things you have to take in consideration, right? When you're looking,
right, you have to take all that into consideration, right? It's up to you to, read what's going on currently, what you're projecting going forward, because all these, the credit put spreads, credit call spreads, they're directional. You have directional risk. So let's take a look, let me just take a look really quickly if I see anything in the summary on the trade ideas. So credit, he said call spread, right?
Yeah.
So one popped up over here and the November 20th expiration, selling the 13 call, selling the 13 call, buying the 14 call for 18 cents. That's a dollar call spread. We think theoretically it's worth 10 cents. That's a 9.3% theoretical edge. Historical probability of success 85%. So we see, that's an out of the money call spread. So that one is already filtered out for us from the screener using the parameters that we set. Is that helpful? Because that's just here. We don't have to search for it. It kind of filtered it out for us. Let me see. Actually, I have 2 minutes. I don't think I have enough time to do the next comparison, but I might leave it for tomorrow. And I'm going to do like a Tesla versus Amazon challenge. I'm going to compare the two and do a comparative analysis. So another thing traders will do is when you're deciding between two different where to invest your money, right, in two different stocks, you might want to do a comparative analysis or a relative analysis to see which one do you think is a better valuation for the expected, growth and margins. So I'm going to do that tomorrow just as a demonstration. I'm going to choose Tesla versus Amazon because I think they're both innovative companies. They're both still run by the original founders. They're both in growing more. Their models are more growth oriented, growing revenues instead of earnings. So let's make a comparison and see where do we think is a better is a better deal. I might get some angry people because I know a lot of people love Amazon, a lot of people love Tesla, but I'm just going to look at the numbers, and show you guys, how to do a comparative analysis, and then obviously you could decide for yourself.
Perfect, D. Great show. Chameleons, thanks for joining us. Thumbs up are always appreciated. We had some new chameleons on today. Remember to subscribe to the channel. You will be alerted to any new videos that are posted. Dima, great job. Thanks so much, my friend.
Thanks, everyone. Have a great trading day. Hope to see